Yo, what's up, everybody? We are on the regular setup right now, home for a short layover before heading over to Calgary for a while. The stream schedule's all messed up for the last 2 weeks. Essentially, after today, the live streams will pop up whenever they pop up. Don't really know yet, but still planning to do some. The voice might sound a little bit weird. I think I have a little bit of congestion from traveling. Generally feel okay. And thankfully, because I started doing a little bit of homework on a tweet that somebody tagged me in. Where is it? This one. Let me show you guys. So there I was, minding my business, chilling. And then I was tagged by that hell of a long, I'm going to just go with TJ. TJ's pretty brief, so just go with TJ. There's a lot more numbers though. And TJ was seeing if we could take a look at it. And the answer is absolutely. I am infatuated with learning more about markets and pretty much everything I can get my hands on. And I have a deep appreciation for anybody that puts anything together that's even moderately well developed, because it takes a lot of time and effort. So it is super clear that as I pop this open, I didn't go through it yet at all. But one thing I can say is it is not a brief document. It's 44 pages. So it tells me somebody put time into this. And I immediately treat that with respect, because especially looking at something like GameStop, there are so many theories, so many avenues, twists, and turns that make it pretty difficult to truly identify what's going on. And I'm always eager to see what people are digging up. Now, a couple admin notes. I approach this kind of stuff with a really poor version, like a semi-varied version of the scientific method. And I try to look for, in the military, we would refer to them as capabilities, critical vulnerabilities, centers of gravity. Those are just terminology frameworks in my mind. Centers of gravity are things that really bolster the concept or the thing. Critical vulnerabilities are gaps, things that we're taking leaps to come up with what we might be thinking is going on. And I try to look at it as objectively as possible, and something like GameStop has a lot to it. So all that aside, I am very much a trader. So there's two parts of my brain when I look at this. There is the part that is looking for how do I trade this thing? And then there's the part that is just interested in how this thing behaves and moves. And this is more to dive into the latter element. People have asked me a bunch of times, especially people that are more familiar with more of my broader content, which is just about options trading, why I'm so interested in GameStop. And I will always reiterate the point for everybody, because I think it's important to continue to promulgate this message. GameStop can teach you a lot about markets that you otherwise never would come across. And I know that from firsthand experience. It has taught me a tremendous amount. And I do not have even a monicum of the answers, but I look to explore them with you all. So, giant preamble aside, let us get set up on the main screen, and then we'll start digging into this bad boy. All right. Now, I'm assuming, I have to assume Newton has already looked at this. And I grabbed his Google Sheet because he has everything that I can think of with respect to things about settlement, which I have to assume that's what a lot of this document is going to be about, settlement. I haven't read through it yet. I'm just guessing, because that seems to be the biggest focus that I find when I look at the look in the community. So with that note, at least. Okay, yeah. So Robert says, yes, Newton reviewed it. Yeah, okay, makes perfect sense. I would appeal to Newton's understanding of this stuff over my own, specifically with respect to settlement and whatnot. He's been spending way more time and effort looking into the dates, the relationship between dates. I won't hold a candle to what he can identify. I will do my best to see what I can see with my own eyes, hopefully offer a little bit of value for the broader analysis. But I absolutely think he will be the main dude I would take a look at. And maybe even during this, we'll pull up a couple of his videos and just scroll through them, because I respect his opinion on this stuff tremendously. All right, so let's get this thing started. I'm gonna zoom this in a little bit so it's easier for you guys to see. And then the other thing I'm gonna do to prime myself is I'm actually gonna upload a version into ChatGPT and have ChatGPT start to summarize it. It says file is too large. As per, I'll probably have to split it up. Okay. Let's see if this thing can summarize it. Only 44 pages. Rapture says, oh, great point, Gemini. Fucking W's for Gemini. Because I already have it uploaded and I already have it configured. Let me delete this. And then let me, this is upload an image. I wanted to look at a file. And review the file named the big DD and provide a summary. Let's see if it can do that. Right now, Gemini, W's for Raptures. It looks like Gemini will be our answer. Here. So let's see what else we can, see what else we can extrapolate out of this thing. Create a bulleted list of each of the main topics with supporting summaries. To be clear, I'm going to go through this whole thing. I do this to help prime what I'm going to be looking at. Again, especially when it's something that I'm less familiar with, priming my brain helps me a lot. So that's all I'm doing right now. All right, let's see if this can continue on that. And then I'm just going to join this up with the other windows I have so that they're all consolidated window. All right. How sick is this? Raptures, you get +2 fake internet points because that was a massive recommendation. Shout out Raptures. The reason why I'm so stoked on this is because this I have in my Google Drive. I have links to hundreds of different studies about things that impact settlement, GameStop, SEC filings. So I will be able to query this against all of that, which I'm pretty excited about. Let's see what we see from a high-level overview first. So from a settlement perspective, it says explains the basics of settlement theory. Fully expected to see this, including trade date, settlement date, different settlement rules defined by the SEC, For those that are unfamiliar with what this all means, it is everything to do with FTDs, and it has everything to do with moving the obligation to acquire shares around. So this is relationships between entities like market makers, authorized participants, stuff like that. This says explores an interesting finding about ETF in a no action relief letter. Funny enough, I literally saw this on Newton's sheet, and I expected that to have something to do with this. So I assume this is what this is referring to. Where a market maker sought permission to use irrevocable ETF creation orders to satisfy FTDs. Okay. Spoofing, a term used to describe delayed settlement mechanism affecting stocks. GameStop's runs are driven by catalysts and can be explained using two sets of settlement formulas, S final, S final. So T1 plus 2, that's initial settlement. T2 35C and 35C minus 1. That'll have to do with the 35-day settlement cycle. And then T3 plus 2, I imagine that's moving back to an authorized participant potentially. So I think this is talking about the bouncing of settlement requirements, essentially kicking. This is like the kicking the can idea, as far as I could tell. We'll get way more into detail as I crack into this thing. This is just at a super high level overview based on two sentences that I'm seeing. So I can be 100% wrong. Want to be super clear. Speculates market makers are using mechanisms similar to ETF creation approach. So this is the ETF creation redemption, using ETFs that hold baskets. ETF holds baskets of different stocks, and the theory is you can use ETFs that hold something like GameStop to satisfy locates and stuff like that. So totally understand what they're talking about here. Rex 068. This is funny because Newton and I, a long time ago, we were talking about Rex 069. So I don't know much about this one. Discusses margin deficiencies, specifically 068, detailed explanation of margin deficiencies, how they are calculated, explains how Rex 068 allows firms to request extensions of time for satisfying margin deficiencies, granting them an additional 14 days. Yep, that makes sense. So this is another exemption that's provided for entities. It's almost like extending a line of credit. Following along with this so far, I'm going to ask it another couple questions once I get through all these. Analyzes several GameStop runs, including the squeeze, the Fed wire, Mario Day run, and the Wombo combo, attributing them to catalysts and their effect. Okay. Provides a detailed breakdown of each run, highlighting the role of essentially I don't know what this boofing term is. It's just like a redemption creation cycles. Rex 068 and other factors like options activity and market sentiment. Okay. Examines two big runs in 24 associated with DFV's return, including run, Lola run, and the DFV's return 068, Rex 068. Explains how DFV's return and trading activity triggered margin deficiencies in Rex 068 extensions, leading to increased volume and volatility. Solves the emoji. I'm not going to lie. I'm actually very excited to see what this talks about with respect to this emoji timeline. I've seen so many people guessing at what this thing is. Revealing it as a countdown to potential MOAS dates, July 3rd and 5th, 24. Really interested in that. The reason why I'm so interested in that is because that's so far out from now. Wait, does that mean 24 or 25? I think this might mean 25. Cost and Chewy provides additional examples of runs on Cost and Chewy, demonstrating creation redemption and 068 are not unique to GME. Highlights the rising floor pattern and cost, suggesting it aligns with lock the float theory. Fascinating. From my understanding, specifically with the involvement of Cost and Chewy, I've always just took that as they're part of the ETF creation redemption cycles. So if they're bundled in an ETF that is affected by the creation redemption cycle. Now, the one thing that I haven't done that we as a community have to do is we have to look at the other names in those ETFs. We can't just look at the names that we're interested in. We can't just look at Cost, Chewy, GameStop and say, okay, when we go through these ETF redemption creation cycles, do those move? Because if the theory holds, then it should broadly apply to most of the names in an ETF. Now, I would feel comfortable restricting it slightly, of course, because things like Cost, Chewy, GameStop, they're not mega cap stocks. I mean, GameStop's like a mid cap stock now, but I mean, generally we refer to them as small caps. So because of that, that's a big RFI, request for information. That's like a big piece of homework that I think we have to do. So I'm actually going to take a couple notes here and create a little bit of a to-do list. All right. So we need to evaluate primary ETFs that hold GME, Cost, Chewy, which I know Newton has this all already. And observe behavior of like kind stocks, meaning market cap by market cap, and evaluate moves, move time, move severity and timing. With respect to GME, Cost, Chewy. Cool. Got that down. All right. Requel discusses the potential for a requel, another attempt at MOAS based on recent events like DFV's time meme and GameStop's Q3 earnings. What does this do? Oh, you can like click into it. Applies the creation redemption formula to predict future potential run dates based on these events. Okay. Reiterates the thesis that catalysts drive GameStop's runs and emphasizes the importance of understanding delayed settlement. Encourages readers to use information to level the playing field. I like that. So then the other thing we have to take a look at is a total list of expected delayed settlement catalysts, a total list, not the times where we think it worked. So that's the next piece of homework. Curate a total list of expected delayed settlement impacts and track GME, ETF, and FTD behavior. The reason why I bring that one up is because when we did this, I did this with Newton a while ago, and we looked through a bunch of these, and there are unequivocally instances where things absolutely line up very interestingly. But the last I looked, there was also a lot of instances where it didn't necessarily so. And again, the thing that's really important when we're looking at these theories is to try to test how robust they are. So then, because that doesn't mean that the theory doesn't hold even if it's intermittent. It just means that we would want to treat it differently based on how robust it is. Like, that's literally one of the basis of Kelly sizing for a position. Now, again, this is Eric taking it from the theoretical element back into the trading world, which again, informing position sizing based on this stuff. Okay. Get back into Gemini, and then I'm going to ask it to expand on all these topics. Expand on all of these topics with 4 to 5 sentences. Search for any relevant research that might apply. All right, and while that's running, get that out of the way for a second. And then I just want to start actually clicking through this thing. I'm going to show you GameStop runs are catalyst driven. Almost all of them can be explained using 2 sets of settlement formulas. Actually, these settlement formulas are not unique to GME, okay? Although I've tried to be as objective, factual as possible, going to be places where I insert on speculations, okay. So there's settlement. Okay, here we go. What is this one? Aha. I figured it was some fucking crazy ass word because I didn't know what the fuck it was. Good. That's a hell of a fucking place to be in life. That right there. Huh. I don't know what you guys think about that. That's a little heavy to be at a spot where that seems like a good idea. But at least now we know. Rexo68 running DFV, running Cohas, that's funny. Requel, okay, cool. So this is good so far. I'm just kind of validating what Gemini is telling us to make sure that Gemini is also at least moderately accurate. Trade date, settlement dates, T+2. This will be probably T+1 now, but I'm assuming they're talking about the squeeze from early 2020. So that would mean this would apply. 35C. Okay, so this is calendar days. Settlement date plus, okay, so they're using calendar days here. That's an important differentiation as well, because a lot of the other settlement theories use different combinations of calendar versus trading days. T1, yeah, so they're just using different settlement dates here. T15 window. Settlement occurs throughout means that the settlement occurs throughout the entire duration of this range of dates. T15 is not only pointing out the 15th day, but the entire range. Yep. Yeah, okay, so they're capturing that new settlement after the change on 28 May is now T1, used to be T2. This is good. S1, participant must close out, fail to deliver for a short sale transaction by no later than the beginning of regular trading hours on the settlement day following the settlement date. So this goes back to one of the things when we did the live stream not that long ago with Kevin Malone and PB. The short theory, as I look at it historically back at 21, I can see what they're talking about, but I'm very curious how it applies today as things sit right now, because the original premise of this is that we think MOAS is going to happen, or there might be another version of it that might be close to MOAS, but not quite, because we also had a couple conversations that I still think are really pertinent for us to discuss internally, which is if structurally MOAS was short-circuited last time, I don't see them allowing it to run further in the future. That's not to say that it can't happen, but I'm saying that what MOAS might look like might look different than the generalized concept of MOAS and the heights that it could reach. So there could be different versions of what it ultimately ends up being. So that enters my mind because as I look at these different settlement dates and stuff with respect to shorts, it begs the question of, again, what do we think the probability is that shorts are still open, that they have not covered, and to what degree is that the case? And I don't know the answer. I really don't know the answer, but it's important to identify that because that widespread short component is the entire primary driver for this theory, which is being driven by settlement cycles. Okay, S3 participant has a FTD. They can demonstrate on its books and records resulted from a long sale, or that is attributable to bona fide market making activities. The participant must close out, fail to deliver no later than the beginning of regular trading hours on the third consecutive settlement day. Okay. If a participant of a registered clearing agency has an FTD at a registered clearing agency in any equity security resulting from sale of a security, that a person is deemed to own pursuant to Rule 200, and that such person intends to deliver as soon as all restrictions on delivery have been removed. The participant shall, by no later than the beginning of the regular trading hours on the 35th consecutive calendar day following the trade date for the transaction, immediately close out the FTD by purchasing securities of a like kind and quantity. Additional time to close out the fails to deliver resulting from sales that a person is deemed to own is provided so that participants can close out such fails with the security sold. So I think most of us are on generally the same page with this. If a participant of a registered clearing agency has an FTD position at registered clearing agency in an equity security to Rule 144 for 35 consecutive settlement days, that's annoying. My little thing cut off some of it. Hold on. Let me finish reading this part. In a sale that actually we can just, yeah, it's okay. So that participants can close out such fails with the security sold as soon as all processing delays have been removed. That's the wrong one I'm reading. Okay, here we go. Rule 144, settlement date. For a sale in that equity security, that the participant shall, by no later than beginning of regular trading hours, 36 consecutive settlement day, following the settlement date for the transaction, immediately close out. So this is just talking about the date ranges that have been established. So we continue. Here's the SEC final ETF rule mentioned above. Okay. Always open links that you don't know what they are. Obviously. And we have this. This is a 259-page document. Will permit exchange-traded funds that satisfy certain conditions to operate without the expensive delay of obtaining an exemptive order in connection with the final rule. They will rescind certain exemptive relief that has been granted to ETF and sponsors. Okay. Commission is also adopting certain disclosure settlements to form N1A and Ep2 to provide investors who purchase and sell ETF shares in the secondary market with additional information regarding ETF trading and associated costs, regardless of whether such ETFs are structured as registered open-ed management companies, investment companies, or unit investment trusts. They're also adopting regular amendments for Form NSEN. The final rule and form amendments are designed to create a consistent, transparent, and effective regulatory framework for ETFs that are organized as open-ended funds to facilitate greater competition and innovation among ETFs. Innovation's good, I suppose. Don't hate innovation, eh? Okay. Don't need all this. ETFs will be considered to issue a redeemable security within the meaning of Section 2A 32 of the Act. ETF have features that distinguish them from both traditional open-ended funds. Defining feature, yeah. We believe that there is more appropriate rule for address the questions of status by classifying ETF shares as redeemable securities. Okay. So it's talking about the redemption creation cycle in a nutshell. The SEC's final, in addition ETF rule, I'd recommend everyone read the SEC No Action Relief Letter, which is, have that already somewhere. Give me a sec. This one. Requests for no action relief under Rule 204 of Reg Show with respect to creations of covered ETF shares for closed out purposes. Okay. Rule 204 requires a participant to deliver securities to a registered clearing agency for clearance and settlement on a long or short sale transaction in any equity security by settlement date, or to close out a FTD position at a registered clearing agency by borrowing or purchasing securities of a like kind quantity. This part is so important, and there's a reason why I'm taking the time to go through this with you all directly. And it's because the broad theory that we're trying to apply here literally hinges on all of this settlement component and timing. So the rules around the settlement and how they're followed or not followed or skirted around make this entire, they literally make the entire theory. Now, again, to reiterate, there's two elements to this. Trying to predict this from a trading perspective is very challenging, I think, at least. I think that from a trading perspective, there are much easier ways to try to play the moves in GameStop. You'll never top tick or bottom tick it, but if anybody has showed you that you don't have to do that, it's the cat. You just have to be involved in it. So from a trading perspective, there's a much easier way to do essentially all of this, in my opinion. And so far, it's been the case from my own experience. But the settlement cycle, rule abuse, and ways that different entities skirt the rules are a bit of a different story. And I think that they highlight a lot of broader structural and integral issues with markets that people should at least be generally aware of. Again, from a trading perspective, most of these rules don't really impact most of what we do. They don't. But I think being aware of it is not going to hurt anybody. And then if you're looking to trade things specifically that are the primary profit mechanism are these settlement cycles, you have to understand them. It's literally the way that the trade is thought to move. Okay. The participant must close out by no later than beginning regular trading hours of the settlement day following the settlement date. If a participant has an FTD position that they can demonstrate on its books and records resulted from a long sale, or it's attributable to a bona fide market making activity by a registered market maker, options market maker, or other market maker, obligated to quote in over the counter market, the participant must close out the FTD position by no later than the beginning of regular trading hours on the third consecutive day. Okay. So I am going to download a copy of this. I'm going to add it to our library. What am I going to call this? This will be no action relief. No action relief. The reason why I'm downloading is because we can also have Gemini help us with this. Summarize the no action relief letter. And then our boy Newton texted me. Okay, cool. Oh, perfect. Even better. Our boy, I hit Newton up to ask him if he's cool with us watching some of his videos. I would never want to use somebody else's shit without asking them. So, but he said it's totally cool. So I'm going to pull up a couple of his videos now. Because I have to imagine I have to imagine I'm reinventing the wheel right now. I feel like he's done this. Essentially, it provides a no action assurance, means that the market participant acts in accordance. Regarding specific, if the SEC grants the relief, this doesn't help me. This is the wrong thing. Whatever, Gemini. I'm just scrolling back through. I had it before. Extrapolate out on all these to see what we can learn. Explain GameStop's price movements, suggesting a link between delayed settlements and price surges. I can see that. 068 allows brokers to request extensions to meet margin calls, potentially delaying the impact of market deficiencies in the market. Okay. This starts to confound things a lot. The reason why I think that this starts to confound things a lot is because if we look at 068 as it sits here, then I don't see why the 35-day settlement cycle wouldn't often change based on people abusing this. So I don't see why they wouldn't abuse this. It suggests DFE's actions triggered margin calls. The emoji timeline decoded by the author adds intriguing layer to the analysis, hinting at potential coordinating trading activity. I'm most interested in this. I'm not even going to lie. I'm probably going to go to that first and give into my immediate gratification desire. I'm so curious what they think about those emojis. Seen so many versions of it, and none of them make sense to me. DFE scheduled a live stream. There goes 68 pattern. perfectly is the volume of the stock elevated for the entire 14. I don't I don't fully understand that. Schwartz must have filed for a Rex 068 extension to fulfill margin. See, this is another part that starts to get really confounding to me is I think that we have to start differentiating between who the shorts are. Because if this makes me think that people think it's market making firms that are the primary shorts and not entities like hedge funds of different sorts that like Citron that are trying to short things. And the reason why that matters is because the way that the rule set is applied is very different depending on the entity. This confuses me because if there's a margin deficiency and they file Rex 068 extension, I don't understand why they would go to the stock now and drive the volume. That doesn't make sense to me. That's the exact time you don't want to go to the stock. And this might be the time where they move to a redemption cycle in a ETF of some sort so that they don't have to go to the stock. Now there could be, and I would love to know why that wouldn't happen based on this theory. I genuinely would, because obviously from this person's perspective, there has to be a logical reason why the participant wouldn't do that. I just don't know what it is. Because from my perspective, if we're saying the market makers as entities are essentially not touching the stock and we're transacting via swaps and we're transacting via ETF creation redemption cycles so that we don't have to touch the stock, I don't understand why they're touching the stock here. This is the exact time you don't want to touch the stock. So that part I just don't fully follow. And the other thing that I generally question that I don't, because here's, to be clear, my opinion is I don't see the massive benefit for market makers to remain and hold massively short positions in GameStop. It's like really arduous for a market maker. I can see hedge funds doing it or different larger institutions that are trying to seller box something. I can absolutely see that. Now, I also want to be very clear. That doesn't mean that I don't think that market makers might have short GameStop positions. I genuinely have no idea. But when I look at this, it looks like so much of this is based around the market maker as the primary short participant. And maybe it's just a differing in general premise, but I would imagine it's closed end hedge funds because they're the ones that have the best access to black box movements to hide things and to not go on open market to grab shares like this. So that part just really, really confuses me. Hold on, Newton texted us. Newton says, honestly, it's sort of reiterating the ETF can kick and the thing we talked. Yeah. The thing we talked about before, 15-day deferral windows and 10, 11-day settlement periods. Pretty excited for the next 3 weeks. So if we, yeah. Dude, so glad you said that because as I started reading it, I'm about 40 min in, and that's exactly what I'm seeing. My question, though, is who do we think the primary shorts are? market makers or hedge funds? Asking because the settlement cycle ideas would apply differently to the participant. I also am struggling to understand why in, what is this, Rex 068? Rex 068, we think that's driving volume on the open market to satisfy the margin requirement. Okay. This is, if any of you guys were to ever go through my text conversations with Newton, it's strings of shit like that I was just uttering into the mic. He and I spend so much time just pondering this shit. We're both equally interested in it. I'm curious what he thinks about that stuff though, like genuinely. Because I'm assuming it's something that we've thought about and that there's some sort of explanation that exists for it. I just literally don't know what it is. So I am pretty confident though that we'll be able to figure it out. So that's one of the questions I have here. So I'm actually going to add that to my to-do list. For Rex 068, why do we think that the margin satisfaction activity would present on the open market versus a creation redemption cycle? Who are the primary shorts, MMs or funds? Okay. Here we go. BW says, I've been holding cost shares for a year now, 1,500 shares just in case. What are we talking about right here? Great question. Yeah, that's the trick when you're talking about this shit, is every once in a while you have to take a pause and pull your head out of the fucking sand and reorient ourselves. So thanks for giving us thanks for giving us an opportunity to do that. So this is talking about a margin deficiency seemingly that a short market maker might experience, and then the subsequent market impact of them attempting to satisfy the margin deficiency is. Now, I think that there's quite a few holes in here with this, and that doesn't mean that there's not answers to them. They're just questions that we would want to answer. And the reason why we want to answer those is because it's a big part of why this thing may or may not work in the way that we think it may or may not. Because we're essentially saying that the volume here is being driven by this margin deficiency satisfaction, which I don't fully follow, but I want to understand. GME reversed 5th June, first of the Rex window, and by 6th June, stock was going parabolic. DFV brilliantly scheduled his live stream a couple days in the Reg 068 window. Sadly, we'll never know if he was planning to shake his 8-ball and exercise his 120,000 calls on stream that day. Well, we kind of know this because he didn't have the money to exercise them. So we do know that he wasn't going to, like, he absolutely could exercise a lot of them. He had tons of money in the account, but he definitely couldn't have exercised all of them. Joseph says, have you gave your outlook for the week? No. So that one will be, that live stream is going to be at 1700. I have 3 live streams today. I have this one right now. We'll probably go for like another half hour or so. Then at 1700, I'm doing for everybody on the YouTube channel the market outlook for the week to make sure that you all have your marching orders while I am out freezing and checking out the mountains in Calgary. And then at 17:30, so half hour in, we're going to switch over to the Patreon stream, and we're just going to talk about like portfolio positioning, answer specific questions and stuff like that. So the market outlook will be a little bit later. Matthew says, just got on. Happy holidays, Eric and everyone. Straight up. Thank you, Matthew. And happy holidays to everybody else. Merry Christmas. We like to do a fun thing for Christmas where I don't like doing all Christmas presents at once. I actually think that kind of like burns out your dopamine. And I think that you get less out of each item that way, because it just becomes like another item on top of a mountain of shit you might get if you're fortunate enough to have families that can provide like that. So what I like to do with Mel is we do like a present a day for, it's kind of random, to be honest. You just kind of start depending on how many are under the tree, and we never really plan that. And then we have to plan it around like travel and stuff. So we do like a random number of presents. One of the things though that Mel got that's pretty fun is a red light therapy thing. It does like infrared light and then like regular light or near infrared. Anyways, the point I'm telling you this, not that any of you care at all, but it's kind of hilarious. I want to set it up in here once because it casts a mean red glare. I mean, like lights up the entire room. It's hilarious. So every time that she turns it on, if the door's closed, it looks like out of a horror movie or something. There's just like red glowing lights spewing out through the door. Yeah, it's actually a more enjoyable gift than I thought it might be. And then the other one that she got before we get back to this is I got her this really crappy. I mean, let's be honest, it's more for me than for her, but she likes Harry Potter. So I got her a Harry Potter wand that like shoots fire, little fire paper things. And I have been running around the house playing with her wand because it works so much better than I ever thought it would have. I thought that it was going to be a giant piece of crap, not do anything. And it literally shoots fireballs. It is so fun, except I started modifying the paper a little bit to make it a little more rambunctious and whatnot. But you know, what do you expect? So let us continue with this. All right, so I'm going to get out of the depths here, and then I want to start going through this stuff. Actually see what we got. Here's yeah, we read all this. Basically, market maker. Yeah, okay, so this confirms part of my theory is that we think that this is primarily market maker driven, which actually I have a buddy that's a market maker. So I'm going to add that to I talk to him like once a month. So I have a list of questions that I ask him typically, and I'm going to ask him. The question I'm going to ask him is, why would market makers want to remain systemically short a stock? And that's like any stock. And I'm also going to ask ChatGPT this. Why would a market maker potentially want to remain systemically short a specific stock? And let's see what they say. Providing liquidity, managing inventory risk. That's not it. Exploiting overvaluation or mispricing. I think they would have gotten out by now. Facilitating hedging for other market participants. That's the most likely so far. I think that's probably the best. That's the best concept for that I can think of. Because it depends on, hold on. So it depends on how far into the weeds we're trying to go here. But if we think that there are market makers that are potentially so far in bed with some hedge funds, then there could be like that motivation for a market maker to remain systemically short could be there. That is a huge leap, which is why and went and got the hat. It's a big leap. But that is objectively a motivating factor that I could conceive of. Joe says, every vacuum I buy breaks. I got 4 broken ones. One, that tells you need to stop doing what we know what you're doing with that vacuum. You need to stop that. Stop that right now. You're going to burn out the motors. Give the vacuum a break and grab something else that's more suitable to the task. You know what I'm talking about, Joe. And then just get a Dyson. Like literally that's all we use is Dyson. They work fantastic. They always survive whatever you put it through, Joe, whatever you might put it through. And they're really strong, Joe, super strong. So I think you just need to upgrade your life a little bit. Joe says, is the guy with a Viking foil hat giving me cleaning tips? This ain't cleaning, big dog. We are sharing tips here, but not that one. I'm just trying to save you from having 4 broken vacuums sitting around is fucking crazy. That's literally crazy. Why would I drove by a vacuum repair shop and I was shook that is still a business. I cannot believe that is still a business. It blows my mind that it literally could be cheaper to repair an existing vacuum versus just buying a new one. In my mind, vacuums are just disposable. Jonathan says, isn't Citadel both a market maker and a hedge fund? Definitely. The problem with that, if we are applying that theory here, is that they're not going to have margin issues. They're just too big. So even if they're holding a certain amount of this float, whatever amount of the float that we think short, I don't think that they're going to have margin issues on the market making side of things. They're just that sizable. Because one of the other issues that I notice we make when we do this, / like have conversations around this, is this. Let me grab my workbook. Handy dandy workbook. And I want to show you something. So typically, and now I'm finally at a spot. Okay, this thing gets so hot. Everybody that thinks that you need like a beanie to warm your head, I'm going to tell you right now, you're irrevocably wrong. You need a Viking tinfoil hat that will warm your head in a jiffy. Super fast. Now, let me show you this. That's not right. Hold on. So this is your standard, highly rotund market maker. He has French fries in his pocket. He has a little table that he carries with lines of Coke like that. And then he has like one of those little silly little rascal hats. Like that. And then he has little fat eyes that can't even open because there's too much extra skin on his face. And he's never happy. He's just kind of mute like that. So this is a direct depiction of a market maker. Now, a market maker, they have a little machine that makes markets, that automatically creates bids and offers for stocks. The thing about market makers is that they don't typically make bids and offers on just one stock. They make bids and offers on hundreds. And I'll explain why this matters. I like how the bid and offer progressively got worse as I went on longer. Here's what happens. This is stock XYZ. This is stock ABC. This is stock 123. They're going to go through different order flows for each of these stocks. So this one they might buy, this one they might sell, this one they might sell. Right? They're going to have a bunch of different ones of these. What happens is at the end of the day, they're going to look at their whole book, the entire book, this entire thing. And they're going to say, what's it look like? What's up? The reason why this matters is because they're not always making markets on individual securities. It's actually rarely the case. So when we're talking about them going into, especially talking about a company like Citadel, because Citadel, the market making arm, is going to do this on thousands of stocks. It's literally one of the largest market making firms that exists. Thousands of names they're going to provide markets on. So in order for them to find themselves in a margin call, they essentially would have need to completely mismanage risk on this individual position. And then they would have to have an entire book where nothing is offsetting any of the risk in that initial position in that other stock. Because when we look at the entire basket of all of the stuff that they're holding at a given point in time, stock ABC might be beta weighted as 10 SPY deltas. It would never be done like this, but it's just for ease of an example. And then stock 123 might be beta weighted as -6 SPY deltas. So their net exposure, once you consider both of these names, their net exposure is long 4 beta weighted deltas. So the main point I want you to take away from this is that it's not done in a vacuum. It's done in a giant bucket with a ton of shit going on behind the scenes. One of the important elements is the ability for positions to offset risk with one another when they look at the composite of the entire book, which is exactly how a market maker is going to look at their book. They're going to track the individual positions, of course, but they manage the risk in the aggregate control of the entire book. So risk management literally is how a market maker extracts their edge from the market because they operate in a near frictionless environment. They don't make a lot of money per trade, But by providing liquidity through the bid-ask spread and capturing that differential, that's how they make their money. So all that being said, it's exactly why you have to remember that they're not just making market on one stock and one stock only. They're making a market on a ton of different things that can have offsetting qualities. And it's why when you have a massive market maker like Citadel, the probability of them having to use Rex 068 or something like that would be very small, likely. Now, there could be strategic reasons why they might siphon out liquidity to do something like this, but we're getting like super niche at that point. Not saying it could or could not happen. I'm not saying that they may or may not be implementing it. I don't know. I'm not there. But what I do know is that market makers operate like this. They're going to be making markets on tons of stocks. The stocks will be looked at individually and then also in the aggregate. And if the market maker is doing a good job managing their book, which is the entire way that they make their money, they then will have positions that offset one another so that they don't run into that situation where they have a margin call, and then to which we might hypothesize that they're then forced onto the open market to satisfy this requirement. I just have such a hard time seeing why they would put themselves in that scenario. Okay. So Newton, based on so let me explain the question I asked earlier. I said, my primary thought though is, who do we think the primary shorts are, market makers or hedge funds? Asking because the settlement cycles would apply differently to the participants. I'm also struggling to understand why in Rex 068, we think that it's driving volume on the open markets to satisfy the margin requirements. Newton says, great question. I had the same, and I believe this would be a powerful tool for designated market maker to handle CNS FTD settlement to manage large buy-ins over time. The margin deficiency could be the DMM specific account for that equity. So in this case, Citadel and GME, big buy, ask for 50-day deferral. I see. Interesting. I don't see that personally, but again, I don't fucking know. Not going to pretend to know. But I don't see how that logically would flow from their perspective. All right, so we have like maybe 10 minutes left. So what I'm going to do is put an earmark in the rest of this FTD. And by the rest of it, I mean literally all of it, since we've only done an overview so far. I'm sorry that I'm so fucking slow with this stuff. I move slow because I insist on understanding each element of something. And it's just time consuming because one, I'm dumb and it takes me a long time to learn things. And two, because I try to be thorough, and rather than just seeing a hyperlink like this and just going by it and taking somebody at their word for whatever it is, like I insist on clicking it and looking at it myself to see exactly what it is. And it's because this is so damn complex that we can't be lazy in the way that we analyze it if we actually want to understand what's going on. And again, my desire to understand what's going on isn't to try and trade this. This isn't how I would try to trade it personally. It's not. This is stuff that I find interesting from a market structure perspective. The way that I trade things like this is already defined. It's actually pretty straightforward and easy for me to do. This, I'm just very interested in it. Okay, so this will be our leave off point on 22Ds post. And that will be my reminder. Super interesting though. So far though, if I were to summarize what I'm seeing, this does seem to be generally highlighting a lot of what Newton has been talking about, which has been the redemption creation cycles and kind of adding another perspective on it, which is great. I'm very, very excited to see this. So yeah, the movement in this has been really interesting. And from a recent timing perspective, it looks super solid. Let me message TJ really quick. And I just want to let them know that I started taking a peek at this. I try to follow up with people that tag me on stuff like that because I like to close the loop. I like to let people know that if they're going to bother bringing stuff to me, that I'm going to try my best to answer it when I can, and then to try and add some sort of value, which I hope I did. The things that I think would add value in this context is trying to get more specific with understanding how we break down the prospective shorts in terms of disposition. Do we think that X percent, and this is what I asked Kevin in PB, because I'm super interested in it, because it has a profound impact on how this whole thing works, is who are the shorts and what's their motivation for remaining short. So yeah, I'm excited to learn a little bit more about that. Rapture says, I want to understand too, so you Gucci. Yeah, that's good. I figured the people that are coming to hang out here aren't the people that are looking for super bright lights and flashy things and, you know, just a ton of overall excitement. I think most of the people that hang out for these streams are more cerebral, because we're literally trying to get to the bottom of something that's super complex, and you can't get there quickly. That's just not how this stuff works. Again, especially if you work with somebody like me, we're going to move slow, because I have to read stuff 62 times before I understand it. I'm a simple man. Archduke PC says, just a quick look. It's super interesting. Wait, what am I supposed to look at? Archduke says, can you take a look at the DD on Archegos swap? I think I've seen that one. We can definitely go further into it, but yeah, bring that up to me on the next one of these that we do. And so for those that don't know, I've been doing this live stream every Saturday now for months, literally months. And the way that it started was looking at every single one of DFV's trade, all of them. Then after that, I wanted to pivot into the theories, due diligence, and analysis that's been done. And we are about halfway through on the Diamond book, which I think is a compilation of several DDs, several meaning quite a few. Then I need to finish going through the rest of the DD library, and then, but I'm going to put those on pause to go through the rest of this, the big DD, and try to see what we can learn. That's the idea. Archduke says, cool. Data dropped on a Reddit post yesterday. Yeah, if you maintain, if you grab a link of it and you hold on to it, just let me know, and then we can take a look at it together. The problem with swaps, I will continue to reiterate, is that us trying to do anything with swaps, it's good to know that they're there and that how they work, but they're beyond that, they're generally meaningless. The reason why I say that is because they are the epitome of a black box. We have no idea what the structure of the swap is. They are negotiated between two parties, and the terms are not, we don't see them. It's a negotiated contract. It's a very sophisticated derivative in that it's not standardized. So the issue with swaps is this idea that as a big swap is coming due and people are going to have to go to the market to buy stuff, it doesn't fully hold, because again, institutions are smart. If Eric, I'll literally draw it out. As you all know, I'm a budding artist, and I just need to draw. I think that's what happens. I just have to let it out via drawing. If I'm an entity that is on one end of the swap, that would lead me to have to go buy stock. Let's say that I was going to have to buy stock on this day, and let's say that the duration of the swap was this period. Do you think that I'm going to wait until this day to buy the swap, to buy the underlying contracts that I would have to hold in order to satisfy my end of the swap? The answer is unequivocally no. You're not going to wait until the absolute last day to do something if you are planning to satisfy it in that manner, meaning to go to the open market to procure shares. It doesn't make sense, Because one, everybody can track it. We can see the dates of the swaps. So everybody can front run that move. That's the whole point of a swap, is for it to be non-standardized and more difficult to detect so that it can't be front ran. It's the same thing with dark pools. The purpose of those is to attempt to obfuscate movement so that they can't be front ran. That's a big problem for people that are conducting really big purchases. So the scenario of somebody that knows that they're going to have to satisfy it by going to the open market and waiting until the very last day to do so, it literally is not logical. I wouldn't do that as a lay retail trader. There's no way that super smart institutions are just like, oh yeah, fuck, this just came up on the calendar today. I guess I have to go slam the buy button on this thing all day today and try to get myself out of it. It just doesn't jive. The next element, the more important element, is as this contract is coming due, they can write another one. There are no rules. So they can take the same contract. They can say, I still like this. I'm going to roll it out in time. And they can do this as much as they want for whatever reason. We also don't know if there's not an early satisfactory component to the swaps, where if the swap is originally this duration, but at this point, they're like, let me get out of this swap. It's done what I needed to do, whatever that is, and I'm ready to exit the position here. So that's the problem with swaps, is that they are literal black boxes. And it does not surprise me at all to see GameStop and a bunch of other stocks. Again, it's not just GameStop. There's tons of stocks like this that end up in swaps because it's really advantageous for people that are trying to do things with GameStop to use swaps to do them, because they are a black box. So yeah, I would love to take a look at whatever the swap DD that came out from Archegos. But my expectation is that in terms of utility, it will be quite limited for us. And I would love for them to be more useful. But I can definitely tell you, I even on the live stream with PB, I asked him if I could take a look at the broader data set and see if I can come up with anything, because I already know parts of what I'm going to find. I know that I'm going to find an entirely mixed bag of stuff. But if I can find anything with a decent correlation coefficient, I still would try to do something with that, because why wouldn't we? The thing, again, the difference between trading and a perfect science is trading is the art of using imperfect information to come up with ideas. So, for example, if I found some sort of correlation between a certain day of the week and something happened in the market, and hint, hint, I've done this before, I will use that. Do I fully know why the day of the week does something? Do I fully understand the background behind it? More often than not, no. But it doesn't matter to me. I'm just trying to trade the effect. Now you can go back later and figure out that some of it are window dressing effects, and there's other things that lead to behavior like that. But it typically doesn't last forever. It could just be that there's a specific fund that's trying to gain entry into something and they're scaling in over time, or whatever the case is. The point I'm trying to make is that even if it's a loose correlation, it's still a correlation, and it's something that we should take a look at. I got something in my eye. So I'm hopeful that with the swaps, we might be able to find something. I just don't know what. But I don't think that they're quite as informative, I think, as people are hoping for them to be. Archduke PC says the swap dates have already expired, correlate to big GME moves like May this year and the sneeze. See, but that's the problem, is that what we're doing is we're overfitting at that point, because guess also what happened during those periods, supposedly OPEX tailwinds, settlement periods also happened. We also had massive options trading activity. We also now have apparently Rex 068. So the problem is what we're doing is we're looking historically at really strange scenarios, and then we're trying to isolate what caused this scenario. And in reality, it's overwhelmingly likely a contributing factor driven by a ton of this shit. Different elements of all of these things coalescing at a specific period in time. Markets are not vacuums. Markets will continue to be extremely complex places that will always have these quirky style movements because of that. Now, again, we should always look at this stuff, and we should look at swaps. I've spent a long time looking at swaps because I find them very interesting. And even if they have a 10% input potential into a model like this, I'm certainly interested in that. But based on the original analysis that I've done, I just hadn't seen a massive input personally, but definitely open to it. And I hope that there is, because the more observable elements that we can clearly identify positive correlation with, then the more predictable the event becomes, which is literally good for everybody. It doesn't fall on deaf ears that I know so many traders are trying to use GameStop as a way to change their current life. Now, it's not my approach. I would love for them to have a different approach personally. That's not to say don't trade GameStop, but I would just love for people to have a slightly higher probability approach to achieving that. But nonetheless, it is what it is. So a big reason why I spend so much time on this stuff is not just born out of my personal curiosity, but it's because I know that there are a lot of people that quite literally their livelihoods depend on elements of this, and I want nothing more than for them to succeed. I already told you the way that I trade GameStop is completely different than all of this stuff. And GameStop is still a small part of my book. It just is what it is. My primary purpose is I'm a trader. It's literally how I make a living. So I have to do things in a way that work for me. But I recognize that other people have different imperatives, and I see a lot of people trying to do something big with this, and I want them to have a solid approach and something that makes sense for them. Star Beef, which is a hell of a name. Star Beef says, this is why I hope moving forward you use less Newton texting. A lot of these debunked theories people are saying come from Newton. He still pumps T35 and daily emphasis on Max Payne. No, fuck no. There's a 0% chance that I'm going to use less Newton. It's an information source. He and I don't agree on all of the elements of GameStop. And that's okay. We don't have to. But the way that you move closer to objective truth is through multiple information sources. So as long as he still remains like the completely grounded, awesome dude that he is, there's no reason why I would stop listening to his opinion of things. He literally, in my opinion, is like the GameStop scribe. That's what I call him, the GameStop scribe. And it's because he's spent so much time collating all of this different data about GameStop. So there's no way that I would turn down the intelligence that he can provide. But as you can tell, I don't take him at his word or anybody at their word. You shouldn't. You should do your own research. But it's like, it's the same thing in the military. Like, we wouldn't turn down any intel. We'll listen to all of it. We're going to screen it. We're going to apply our thought process and our analysis to it, as we should. But there's absolutely no reason why I would turn off an information source, because what he does is at least researched and tracked. It's not completely random. Now, it's the same thing I notice with other people that I'll interact with, and you guys will hear me do this. I will say, is this something we can prove, or is this a hunch? Or is this a theory? And the reason why I ask that question, one, is to check the framing of things so that people aren't misled. But the second is also to test the person. And how effective is the person at differentiating reality from something that we might think to be the case? Because something that we can objectively prove is different than a theory or something like that. So yeah, I totally dig Newton. I think he's rad. So yeah, I'm 100% going to ask his opinion on stuff like this, especially on things that I think he knows more than me, for sure. And then I will always fact check everything. You guys see me do that literally with everything because it's how I apply my process. So yeah. Starbeef says, this is why I hope. Oh, I already read that. Matthew says, you're a good person, Eric. Never change. Thank you very much. I appreciate that. I hope to be. And I hope to continue changing, but hopefully for the better. Rapture says, even if Newton is wrong, that's how we learn. I agree. Newton's data isn't his theories could possibly be, but not the data he's noted. I don't know what that pertains to. Sorry, I probably moved past it too fast. Notion says, is market and or GME going to rip or crash on money? It's a great question. We're actually going to take a look at that in a half hour. So on the 1700 live stream, I'm going to go through the market prep for the week. And then when I get back from travel and whatnot, I'm going to start a daily live stream every single day for the YouTube channel. And then the Outlier Pro live streams will still be on Sunday and Wednesday. I might actually bump up the frequency and just cut back the time on some of the other ones so that we can cover a little disparate data, because for the pro live streams, we get more into like my specific portfolio, actual trades, trade adjustments, stuff like that. And then working through individual people's trades as well to try and help. And then on the main channel, we do more broad analysis. We do scanning. We do like theoretical learning and stuff like that, because I think that that's timeless, applicable to everybody. And my original objective for doing this whole thing is not changed, which is hopefully to spread and share information for people to arrive at their own conclusions for stuff. So thank you all for hanging out, for being a part of the game. And also thank you for helping me learn. I enjoy this very much. I will see whoever wants to pop out for the market update or for the market outlook live stream in a half hour. We're going to look through the market as a whole, look through some news, see what's going on with the broad market. And then the pro members, I'll catch you all at 1730 to go through some portfolio updates and whatnot. So we are packed. We out here. I'll see you all in a little bit. Be an outlier, be an ape, be an outlier ape, be whatever makes you happy. I'll see y'all later.